Good afternoon, everybody, and welcome back to the next session of the Share Conference. My name is Agnes Watson, the co-founder of Stockbirds, where we are reimagining how companies engage with their individual investors. Just a quick reminder to please submit any questions you have, and we'll do our very best to try to answer them. Right now, I am thrilled to be speaking with Heather Crowell from the Pennsylvania Real Estate Investment Trust. Heather is the Executive Vice President for Preit, where she's responsible for marketing, communications, and investor relations for the company. Now, me and her have been talking, and I know Preit is incredibly passionate and excited about individual investors, and I can't wait to hear a bit more about what makes them a great investment. Heather, wonderful to be speaking with you. I'd love to start off by having you tell us a little bit more. Please tell us a little bit more about Preit.
Sure. Thanks for having us. So Preit, we've been around for 60 years, which is an incredibly long period of time. We're a real estate investment trust. So we've seen over our 60 years, we've been in different sectors of real estate, but right now, since 2003, we've been focused on the retail space. So shopping malls, primarily on the East Coast, Philadelphia and DC suburbs, where we have just a tremendous opportunity to continue to evolve our offerings. So taking a step back, we've seen it all. Like I said, 60 years is a long time. We've seen it all. We've seen the shopping mall evolve. We're continuing to evolve it. We kind of view ourselves over the past decade as sort of disrupting the space, so to speak. We've been, leading the change in responding to consumer behavior. We've sold off, lower productivity malls. I think, you hear people talk about there's too much retail space in this country, and we sort of agreed with that. So we sold properties that we didn't think were going to be malls, and some of them aren't today, frankly. So we sold those. Then our next step was to repurpose department stores. So the department stores you used to go to as a child, you might realize aren't there anymore, right? There's very few Sears stores and even fewer stores that don't exist. There was Strawbridge's in this market that's gone. Filene's gone. So there was tons of department stores that we all sort of took a step back and said, there's not a necessity for all of these. Let's recapture these and replace them with things like dining, restaurants, entertainment, the Dave and Buster's, the bowling alleys, things for people to do, gyms, right? There may be a gym at your local mall, movie theaters, office space, co-working spaces. We've got a few of those, unique small businesses. And now we're even moving into bringing apartments and hotels onto our properties. So, we've sort of evolved over the years, right? We're primarily shopping malls, but the mall model has changed so dramatically that we're not focused solely on retail anymore. We're focused on kind of an all-encompassing experience for our community. So, because of this work, because we've changed our platform so much and got out ahead of it, we're experiencing right now, an ability to capitalize on this incredibly robust consumer recovery that we're seeing post-pandemic, because we have such a variety of tenants in our shopping centers, right? So if you think about what the consumer knows, the consumer typically knows the brands that they shop at, right? They know Macy's, they know Nordstrom, they know J. Crew, and every other retailer out there, but they don't know who owns the mall that they're walking through. So that's who we are, right? And it's up to us to try to create the most dynamic experience that we can for all the consumers that are walking through our properties, and stay connected to our communities and make sure that we understand what they need so that we can bring in the best and the newest tenant that's going to serve their needs.
I love that. When people go into malls, they walk in them, you're right, they know all the shops, but they don't realize that the company that owns that mall is publicly traded. And that's what I think is so exciting.
Right.
You mentioned a little bit, malls have been kind of losing their popularity over the last few years, but it feels like they're picking up some steam. Like, people are social creatures. They're getting out there. I'd love to know what you're seeing about, are people getting out to the malls? Are they actually feeling them? Are they out there?
Yeah. Yeah, so we are definitely seeing that, being cooped up for over a year has really had made its mark, I guess, on the consumer. They're out there in droves. We're seeing more people in a number of our shopping centers than we did in 2019. So we're seeing people get out. We're seeing that they want to get back out and they want to socialize. They want to be with their friends. They want to be with their family. They've saved up money. They've got money to spend. So the other thing that we're seeing, which is, a significant measure in our business, is that retailer sales, right? Because the health of our retailer that's in our shopping center contributes to our health. That retailer sales have been, just through the roof. And so that means that not only are people coming out to the shopping center, but they're spending money, right? So they're itching to get out. In many cases, some people, I hear, rumor has it, don't tell my husband, but some people didn't spend money on clothes for the past year. But, now they're getting out. They've got new things to buy. They've got new styles to kind of adhere to. And again, we saw great sales, over the past few months. We're kind of just on the cusp of getting kind of final back to school information, but we're also expecting a crazy holiday season this year, a very robust holiday season. Retailers are predicting great sales. And I think, frankly, they're starting early because there's been some, supply issues. So I think, people are getting out there, and our expectation is that momentum just continues from now through the holiday season.
I love it. Now, I know you guys have been incredibly successful and very innovative. You mentioned malls, you mentioned apartments, you mentioned hotels, you mentioned lots going on. Tell me a little bit about what makes you guys so successful, and what makes it to the company culture that drives this great innovative thinking.
Yeah. So I think there's a few things. I think, first and foremost, we're fighters, right? And we don't take not that we don't take no for an answer, but mediocrity is really not an option for us. Never has been. But I think also our size, right? We're big enough to matter, but also small enough to stay close to our markets and to our properties and the consumers that are in them. We're able to employ unique and customized solutions. Like I said, like what's right for one property might not be right for another. That we kind of have, we take our cues from the communities that we're serving. So if it's the right tenant for that property, that's what we go after. But also, the location and quality of our portfolio, we're engaged with the best of breed national tenants, but again, ingrained in our communities and focused on developing the smaller business. And we think those small businesses are what makes our properties unique. So the small and local tenants that you find in our properties are what make them a little bit different than everybody else's, mall. I mean, there was a time in this country where every mall was pretty much the same, right? We pretty much had the same tenants across, and we were, all the developers were out there building them, and, they would kind of pop up and they were a little bit cookie cutter. So, we sort of pride ourselves on creating something that's different and unique and really speaks to, the community that it's in.
Yeah. Do you have a favorite mall?
Oh God, it's like asking me if I have a favorite child.
All of them.
All of our malls are my favorite. So I think, and they're all different, right? They're all for a different purpose. We have malls here that, in our Philadelphia market, where we have, Legoland and Dave and Buster's. So that's kind of the fun mall, right? And then there's malls that have, slightly, better retail for somebody like me, right? And has a family. So I think, I think it's all about what suits that consumer. And for us, it's the quest to find what's going to work in each community.
Yeah. What are you guys doing at the company and mall level to get customers excited?
Yeah, well, I think it's all about customizing, right? So creating that customized platform, whether that is in the tenants that we're bringing in or the events that we're hosting. But, in some markets, a grocer might be a good fit. We just opened an Aldi, our very first Aldi in Dartmouth, Massachusetts, at a mall. So we have a grocery store at the mall. In others, it could be, an entertainment offering. And within the span of a couple of weeks, we're opening a family entertainment destination in Florence, South Carolina at Magnolia Mall, where, area residents would have to travel right now over an hour to find a similar facility. So, for us, it's about like finding that hole and filling it, right? So filling it with what that community needs. And, we're excited also to be we found ourselves being the dominant player in some smaller markets where competitive properties have unfortunately failed and are shutting down, and we get to bring in new and exciting uses that are perfect for them. So, we're really ears to the ground trying to figure out exactly what's working for that town, city. And at the same time, we're focused on things like rewarding our customers, right? We want to create that relationship with the customer. And this back to school season, we offered shoppers a reward for shopping at our property. So for every $200 they spent, they got to choose a $25 gift card to a retailer of their choice. So, we're just trying to find unique ways, innovative ways. Last summer we had, when it was, people were favoring the outdoors and still are in some cases, we launched a park and play series where we had, movies out in the movie theater. So, movies out in the parking lot, excuse me, which was, it was nostalgic. Movie theaters were closed. We found ways to give our community some sort of family entertainment. So they came out, they were in our parking lots, they could get food, and they watched a movie, which, was kind of, unheard of for at least the past 20 years, right? People hadn't been doing that. So things like that, drive up carnivals, so we're trying to give people reasons to come together and reasons to be happy and to benefit our tenants, right? So it's kind of a circular situation. Our malls are, they create jobs, right? Which creates taxes, which, keeps our communities going. So it's in our best interest and everybody's best interest to support that circle of life, if you will.
Yeah, I love the movie things you guys did over the summer. I saw some of that and I thought it was like, yes, I love that you're reinventing yourself and just going with the flow and like, just, let's just go with it. This is what it is. Let's just do it and make the most of it.
Yeah. Yeah.
There's a few REITs out there. How are you different than your competitors?
I think in a lot of ways, but I think like one of the things we sort of touched on already is our size and our geographic footprint, right? So people recognize the towns that we're in, right? They understand it. And, that depth in these densely populated markets is what has given us the ability to go out and find apartment developers and hotel developers to help us convert our properties into mixed use, right? It's more sustainable. It's, it's a place to go and, play, shop, dine, stay, hopefully at some point, right? Where it kind of is the entire picture. None of our peers can say that they have leased all of their anchor spaces, right? So it was something that we set out to do proactively before, the department stores started closing stores. We were taking them back and filling them and saying, you know what? I don't need a Sears here. What I could use is a Dick's Sporting Goods and a Dave & Buster's. So, and that's what the community wants. And we're seeing that sales, are 4 or 5-fold what they were previously. And so that means that more customers are coming, they're spending money, they're probably flowing into the rest of the mall and they're shopping more. So, I think our positioning in the REIT market space is that we're smaller, we have a geographic footprint, and a unique portfolio composition. And our scale really, it allows our portfolio to be understood by investors, right? We're 19 properties. We don't have 152 properties that you have to start to understand, look on a map in terms of where that town is. You've heard of the places that we have properties in. So I just think it's pretty tangible for investors.
Yeah. You understand your market very, very well.
Yeah.
I have a couple of questions that are coming from investors, if you don't mind spending a couple of minutes on that. The first one is around preferred dividends. Do you expect to pay preferred dividends? And if so, when do you plan to pay them?
Yeah, so we are currently limited in the dividends that we are, our dividend paying ability based on our current credit agreement. So right now we're limited to just maintaining REIT compliance. So, I mean, we would love to. We've got to consider all of our stakeholders, and hopefully within the next, year and a half, when our credit facility matures, we'll get back to a place where we're able to pay those dividends.
Okay, perfect. Next question is around debt. An investor is asking, you guys have some debt. What is your plan for paying down some of the debt? And when do you expect to put that plan into action? He's saying, or she's saying, relying on earnings alone will not get you there.
Right. So yeah, I mean, as of the end of the second quarter, we had reported that our liquidity is tracking ahead of our plan. Again, that's attributed to the stronger, recovery in collections, right? So during the pandemic, some retailers stopped paying rent, but we worked out, agreements with them where we would postpone some of those rent payments. And frankly, they've been so healthy and they've rebounded so much faster than expected that, their improved health has allowed us to collect the owed rent faster. So liquidity is tracking ahead of plan. We're otherwise intently focused on creating opportunities to harvest capital. One of those is the apartments that we're talking about. We'll be selling that land to developers, right? It's not exactly what we do. So we'll sell land that's currently underutilized parking lot space, and a developer is going to pay us for the land and build an apartment complex on it. We're pursuing other densification opportunities, including, adding senior living, adding hotels, and frankly, other asset sales or joint ventures, right? So we have real estate. It has value. Our hope is that we'll be able to, to capitalize on some of that. We fully recognize that we have more debt than we would like to. It's kind of a function of timing, right? Which was we spent money reinventing our assets, which we just talked a lot about. And when it, sort of came time to harvest the returns, we were faced with a pandemic. So like I said, we're seeing an incredible recovery, and we think, we're going to continue to be on the right track. So it's kind of a matter of time and realizing the value of our real estate. So.
Gotcha. You mentioned this a little bit, but there's a next question that's come in, which is specific to capital. What sources of capital, and it's kind of a specific question, from the following list do you expect to be the most important for reducing leverage over the next 2 years? Is it organic free cash flow, multifamily land sales, selling JV interest in entire properties to institutional investors, selling JV interest or full ownership stakes in entire properties to other REITs, out parcel sales, or equity issuance?
I would say I'm not going to go in order necessarily, but I would say that, multifamily land sales is our top priority right now. We're well on the way to receiving our entitlements, which is sort of a precursor to being able to close on those transactions. We've got our properties are under executed agreements of sale. So we've got buyers, we've got interest, we've got agreed upon terms. We have to get local approvals in order to close on those sales, but they're a top priority for improving our balance sheet, but also for creating these, mixed use environments that we are trying to create. And like I said, it's kind of a, we'll look to sell joint venture interests or sell an entire property, but, interestingly enough, we keep talking about this great recovery, but the investing world hasn't quite caught up, right? So the value of our properties hasn't yet been recognized, and we know it's there, and we know that it will come. But I would say that that's probably, that's probably the second piece of this. I think out parcels, we've done a number of out parcel sales. We'll continue to look to kind of monetize those as well. But, all of these steps we have to factor in what kind of creates that, the environment at our properties that we just talked about, right? So if you sell off a piece of land, you have to sell it to the right buyer, in order to kind of ensure that that the property and the entire experience remain what you were hoping for, right? What you set out to do.
Yeah. Another question's coming. Could you tell a little bit more about or could you discuss a little bit more the current leasing environment in general?
Sure. We've had a great year from a leasing perspective. I mean, we're on track to lease twice as much space as we leased in 2019, which is amazing. And frankly, more new space this year than we have leased in the past 5 years. So we're seeing it across a variety of different types of tenants, right? So we're seeing retailers out there now, which is something that actually for the past few years you were leasing space to dining and entertainment, but now we've got the retailers back on track. We just opened a number of Windsor stores and signed some transactions with Aerie, which is owned by American Eagle. So the retailers that we're seeing that performed or that are performing are now kind of capitalizing on some excess space that's available by opening new concepts or by expanding. And like I said, our properties were kind of positioned really well coming out of this pandemic because we had spent money, we had repositioned them, and we kind of are reaping the benefits of that. We're hearing from certain tenants that they perform better in our portfolio than in other portfolios. And again, at the same time, we're leasing space to restaurants and entertainment concepts as well, including other uses, like I said, like a grocer and self-storage. We're really trying to figure out what fits each model perfectly, right? So if you consider each mall to be its own model and you have some space available, what needs to be there, right? Where we took underutilized basement, we had a basement level underneath one of our properties in the DC market, and it was never leased, and we leased it to a self-storage company. So now this is a market where they've had tons of apartments pop up kind of right on the periphery of the mall. So we're just seeing a huge variety, and we think the work we did prior to the pandemic in reshaping our portfolio and managing out the assets that we didn't need has put us in a position to really capitalize on increased demand from not just from consumers, but from tenants as well.
Very good. There's also there's a few actual questions that are asking a little bit more about loans. Is there, I think it goes back to the debt question. Yeah. Do you want to just clarify a little bit more about your debt loans and maybe touch a little bit more on that? There's a few questions coming in.
Sure. So we entered into a new credit facility toward the tail end of last year, and like I said, we are pretty confident that we have more debt than we would like, and our plans to sort of reduce that debt are in the works and coming to fruition. I think primarily it starts with the multifamilies, right? Selling the apartments to the developers. We've got them under contract. We'll execute on those rebidding opportunities, right? To the extent that we believe that they have become more valuable, we may rebid some of those or reprice them or really test the pricing. Pursuing additional opportunities, including hotels, senior living. It's not a mystery to us. It's not something we're not cognizant of, that our debt levels are higher than we would like them to be. But our situation was one where our properties were being valued at the worst possible time. So we feel like our recovery and the results that we've been putting out are exceeding our expectations, which is sort of something we've been communicating, and that we're positioned well to continue to realize the value of the portfolio.
Yeah. What you keep saying about, the apartments and the hotels and assisted living, I've traveled so much abroad, and I'm so used to, especially in Asia Pacific region, where you actually have that. Here's your mall, and here's everything else that kind of goes in the community. I'm so excited about that because, I actually talking to you today, it's the first time my mind's going, of course. It's like that's an aha moment going, it exists and it functions and it works really well in other areas. It was literally just the aha moment going, of course, it's so logical. It makes so much sense. I'm so excited for that.
And like you said, other countries have been employing these models for years. We have sort of an outdated model where we've got these sort of a sea of asphalt around our properties. And, it's a little bit archaic because there were parking ratios that we had to maintain. And the reality is that land is better utilized in today's environment. So, it's a multi-pronged benefit where we'll get more shoppers for our mall, but we'll also, be able to reduce our debt levels. So it's kind of a win-win for us.
I'm so excited because you can see all the different revenue streams. It's not just the one. It's like, here's everything else that's coming into play. I'm so excited for you guys. It's fantastic times ahead. And I love the innovation and I love the creativity and I love the it's okay. We're just going to go with something. And I get excited. I could keep going. Our time's running out, so I'm so sorry. Is there anything else you want to add, Heather? Any kind of questions that you always get asked by institutions or investors or something that you want to share?
No, I mean, I think the key message here is that the mall is not what you remember it a decade ago. And if if you want more information, visit us at Preit.com and reach out to the investor relations team, and we'll be happy to talk you through it, because we think that there's a really exciting opportunity ahead for us.
I agree. I'm really genuinely excited for you guys. I am so looking forward to having this in like a year or two or three and actually seeing what you guys are doing and the creativity that's come into fruition. Heather, thank you so much for your time. This was wonderful. And I've learned so much as well. Everyone, thank you for joining this session with Preit. Up next is Verano at 2 p.m. You can join that session by clicking the next arrow on the right of the page or click into the Verano title on the homepage. Heather, have a wonderful afternoon. Thank you so much. Looking forward to continuing our chat at some point.
Thank you. You too.
Bye.
Bye now.